we are going to get into the detail of actually trying to unpick some of the theory and look in practice at actually what is happening on the corporate side of the house. And to help me do that are two fantastic people. First up is Professor Simon Dietz, who is an environmental economist at the London School of Economics and also the research director at the Transition Pathway Initiative. And he's going to be providing some analysis of the state of climate action in the companies that they track and they follow. And then also with me, when we go into discussion, is going to be Richard Manley, who's the Chief Sustainability Officer at CPP Investments, which is one of the biggest asset owners in the world. So he is the money guy, and so we can really kind of talk about kind of how investors are holding companies to account, and if indeed they are. And so we can get into some of that discussion. So first of all, I'd like to invite my guests up. Simon, you can take the lectern. Richard, you join me over here, and we will see the results.
Thank you, Jane. Good morning, everyone. So, as Jane mentioned, I was asked to prepare a brief presentation on the state of corporate climate action. And given that this morning's session is about transition planning, I'll try to put a special emphasis on that. So just to begin with, for those of you who are new to TPI and our research, I'll just say a little bit about our methods. We mainly assess corporate climate action in two ways. The first is that we look at how companies are managing climate change and the governance arrangements they've put in place. We call this management quality. So we have a set of 23 indicators, each of those you could think of as a management practice, and we use those indicators, which are provided to us by our colleagues at FTSE Russell, to arrange companies on one of 6 levels, from being demonstrably unaware of climate change to being at the stage of transition planning and implementation. And the second way we assess companies we call carbon performance. This quantifies companies' emissions, both historically and in the future, based on the emissions targets they've set. And crucially, it compares companies' emissions pathways with pathways for their sector that are aligned with international climate goals, like 1.5 degrees and below 2 degrees. And I really want to stress, as I always do, that you should see these metrics as complementary, right? So management quality looks at inputs and effort, and carbon performance looks at the outcome that ultimately matters, which is emissions. So what I'm going to do now briefly is just show you the current state of corporate climate action according to these two frameworks. So firstly, on management quality, these data are from December of last year, covering 2,000 companies in 24 sectors, including all the high-emitting sectors. And what you can see here is by now, most companies, around 80%, are at least on level 3 of our framework. What does that mean? Well, we call level 3 integrating into operational decision-making. So practically speaking, for a company to be on level 3, it needs to have acknowledged climate change as a business risk or opportunity. It needs to have set a climate change policy. It needs to disclose its operational or scope 1 and 2 emissions, and it needs to have set some form of emissions reduction target. So we can say that once a company's reached level 3, it's done in some sense the basics. But there's still a lot more for companies to do. And so while it's positive that most companies are on level 3 or above, you can see here that less than 10% of companies in our data set have reached the stage of transition planning and implementation. Just to comment on trends, over the years that we've been measuring management quality, it goes back to 2017, we've generally tended to see slow progress up the staircase, if you like. So more companies moving up than down, and a slow movement of the average score upwards. Now, these are the data on an indicator-by-indicator basis. I don't want to go into this in too much detail. You can see that the evidence to underpin the previous chart, high scores on things like acknowledgement, policies and targets and so on. But what I particularly want to draw your attention to are indicators 19 to 23. So these are indicators that we recently added to the framework to measure some aspects of transition planning and implementation on a sort of sector agnostic basis. And what you can see here is that companies currently do very badly on transition planning. So less than 10%, less than or equal to 10% of companies across our data set score on any of these indicators at the moment. So it shows you that while there are some isolated examples of good practice, I think it's fair to say there are no companies that we would consider to be perfect on transition planning out there. They are, as I said, isolated examples. So onto the other side of our data set, carbon performance, what I'm showing you here is alignment of companies' emissions pathways with different international climate goals on different timeframes. These data are from last year's State of Transition report, covering just over 400 companies in the 11 highest emitting sectors. What you can see here is, very roughly speaking, 1/3 of these companies aligned with either 1.5 degrees or below 2 degrees in either the short, medium or long term. So most companies not aligned with international climate goals on any time frame. In terms of trends, we've also seen positive trends over the years, and particularly we noticed a jump in the number of companies with genuine net zero by 2050 goals from about 7% in our 2021 State of Transition report to 30% in last year's State of Transition report. When I say genuine net zero goals, I mean net zero goals covering a company's material emissions from their whole life cycle. Okay, so management quality and carbon performance already tell us a fair bit about transition planning. But since this session is about transition plans, I also wanted to tell you something about our recent work on net zero standards. Because this work provides a more granular view on transition planning in some key sectors. We think of our net zero standards work as, among other things, bridging the gap between management quality, which is, in a sense, shows that companies are putting in place the governance arrangements and management practices necessary to deal with climate change. Net zero standards are a bridge between that and the eventual emissions reductions that they are aiming for. What are our net zero standards? Well, they build on the work we've been doing for the Climate Action 100+ initiative to construct and score companies on the net zero company benchmark. You might be familiar with that. Now, the net zero company benchmark is sector agnostic, right? It was designed in order that investors could compare companies across different sectors. But investors are increasingly asking us more in-depth questions about transition plans in specific sectors. So these net zero standards provide sector-specific methodologies with a particular focus on strategy and capital expenditure. And this work has been done in partnership with the Institutional Investor Group on Climate Change. So I'm going to show you very briefly a couple of slides with results from this. I'm only showing you this to give you a flavour of what you can do with this analysis. I'm not going to go through the details. So what we have here are data for 7 oil and gas companies, focusing on 3 particular areas of the net zero standards: strategy, capex, and disclosure. First thing that will strike you is the predominance of red, right? So we see generally poor performance, which is consistent with what we saw in the management quality framework on transition planning. But here you can see more granularity, right, on what companies are doing relatively better and relatively worse, tailored to the oil and gas sector. For example, they're relatively good on methane abatement measures and on emissions disclosure, but relatively weak, and I think this makes sense, on things like climate solutions and production forecasts. Okay. Similar data here for 5 diversified mining companies, focusing on the areas of strategy and capital expenditure. Generally, somewhat better performance, which is also something we see in our management quality framework. And again, more granularity on the specific areas where diversified miners are doing relatively well, like transition materials and shipping, and areas where they're doing relatively less well, like, interestingly, methane, in contrast to oil and gas, metallurgical coal, and downstream processing emissions. So just a flavour of the kind of work we're doing on this through the net zero standards. So let me just summarise these slides. I think I've more or less kept to time, which is rare for me. This talk is about 99% shorter than the ones I usually give at the university. So since 2017, we've been assessing companies on management quality and carbon performance, and these are complementary views on corporate climate action. So companies are acting on climate change, and we're making progress, but there is still this gap, which we could call the corporate climate action gap, to mirror the emissions gap that we see more broadly. Very few companies satisfy management quality indicators related to transition planning and implementation. Our net zero standards work tries to provide a more in-depth sectoral analysis of transition planning. So far for oil and gas and diversified mining, we hope to be able to expand that in the future, subject to funding, which if any of you would like to give us, we'd be very keen to talk to you. And in relation to that work, the corporate climate action gap is also evident here. But with these more granular analyses, we can better pinpoint areas of strength and weakness in a way that's tailored to the sector and identify strategic decision points, both for the companies themselves, but also for the investors who are engaging with or investing in or considering divesting from these companies. Thank you very much.
Right, Simon, you can come and take a break for a bit after the mini lecture and funding pitch. I apologise. Actually, I don't. You know, they're a great organisation. And that's why LSEG is super keen to support and continue to support the Transition Pathway Initiative, because as you can see, the information and insights and the analysis coming out of that research is really kind of a level beyond what is otherwise available. And I think it's that level of detail that enables investors, such as CPPI, to have kind of robust engagement with corporates. So, Richard, I wanted to start, I guess, by kind of talking at the very high level, because we're here kind of thinking about ISSB. So let's just focus on that for a moment, and then we'll come into some of the results that we've just talked about in terms of your reflections on that. So I'm keen to understand how important or not do you see the developments around ISSB and climate transition planning be from your perspective?
Critical. And so critical, in fact, that we have actually actively participated in all, I'd say, the precedent standards. So relatively unique in having been members of the TCFD, being active members in the ISSB standards, including chairing the effectively inaugural ISSB Investor Advisory Group, and being a member of the TPT. So it will be probably no surprise to the audience today that we are not going to be articulating a view that there isn't systemic value in these. In fact, we view this as systemic market infrastructure. That this is critically important information to ensure that policymakers, boards, and investors have the insights they need to meet and they require to move things forward. And maybe as we think about this, I'm going to slightly reframe, I think, some of the arguments put forward earlier on by Sue and Mary, because I think they're absolutely right to say at a system level, the benefit of comprehensive disclosure of this data will accrue to the market and the system. But we should not lose sight of the fact that the primary beneficiary of preparing an ISSB disclosure is actually the board and the company itself. Okay? And I just frame why that is. Governments across the globe have provided forward policy guidance via their NDC that they intend to provide policy interventions to deliver the comprehensive decarbonisation of their economy by the middle of this century. That is a warning flare to boards across the world that policy is coming. The second consideration is that whether policy comes or not, we are moving towards a higher warming outcome. That will bring with it physical risks to businesses. Okay? If your job as a director is to provide oversight and counsel of the executive to ensure that material business risks have been considered in the setting of strategy, its operational implementation, and your communication to the market, I would contend it is quite difficult to discharge that duty if you haven't walked through what is embedded in S1 and S2. And maybe it's worth just a note then on what are our expectations of boards. Well, our expectations are that they will demonstrate they can provide that material oversight of these risks. But specifically, as we think about our maturity assessment of a board as it pertains to sustainability, is demonstrate there is clear governance framework in place that provides oversight of sustainability in the company. Conduct a materiality assessment. Actually understand what are the issues that are material to the business. And then even conduct a gap analysis to what policies and metrics do the industries that are best in class in our sector prepare and report. And that in many ways was work already done in the SASB standards. Now, the SASB standards were locked down in 2017. I think a lot has changed in the world as it pertains to employee engagement, digital, nature in that time. And I think the ISSB is working to address and market some of those standards, but understanding what is material to the enterprise. And then is ensuring you actually understand the emissions baseline. Not only the quantum of emissions, but where are they coming from? Very difficult to think about how we drive decarbonisation without understanding those two dimensions. Then we would expect things to be conducted that we call an abatement capacity assessment. Actually, that is working out how can we decarbonise, what is economic, what is the physical risks that are presenting themselves in the portfolio, how much would it cost to drive abatement, and the collective of all of those insights converts into a transition plan. Now, we're not prescriptive about what the transition plan should be. We acknowledge that the executive themselves and the board are fiduciaries, and that they do need to consider prevailing regulation, prevailing economic of different technologies, and prevailing carbon prices to determine what is actually what we would view as technically and economically feasible to abate now. And I think we would really challenge, if there are molecules in your business that are technically and economically feasible to abate, why are they not in the plan? Then those emissions that are likely to become economic over time, as policy or economics change, when will that be pulled into the plan? And lastly, for those emissions that are uneconomic to abate, or technically not possible to abate, what is it you are doing as an industry to potentially mobilise innovation and capital to solve those challenges? And the benefits of that clearly accrue to the board. And as I would ask any directors here today, if you don't have those insights, if your company is not able to put those into the public domain, is there work the board should really be advocating for to put the company on a footing that aligns with that long-term guidance? But the other real benefit of that is not just us as owners of the company, but also policymakers, because what is not proven to abate is likely to require an intervention to make it economic. And what is technically not possible or profoundly uneconomic to abate are probably the areas we should be mobilising innovation and venture investments to try and solve some of the moonshots we will need to get us to where we need to be over the long term. So we are firmly aligned. And when people asked us the question, Richard, if those are your expectations of us, what is the easiest way to meet it? Align your reporting with the recommendations of the ISSB.
I think it's an incredibly important point that you've just raised, which is the difference between disclosure for disclosure's sake versus strategic action and planning of a company's kind of long-term fortunes, and actually disclosure then being an output and an outcome after that. So
just an anecdote on that. Look, as a member of the TCFD, we felt quite compelled to actually file a TCFD report. So we made a very clear commitment as it was in flight that we would do it. I would say the biggest benefits that accrued to us as an organisation was not the publication of the report. It was all the work that had to be done in its preparation and the capacity that was built, the fluency in what was the risk that we were owning and how we would ultimately manage that.
Yeah, I think it requires a mindset, doesn't it? It requires a mindset to look at kind of the value to extract from the process, just not the disclosure itself. Good. Okay, understood. So let's move on to some of the reflections and the insights that Simon shared. You spend time talking to corporations around climate risk, etc., amongst many other things, I'm sure. Does this look right to you? Does the data kind of reflect what you're hearing and seeing?
It does. And I would look. I heard Peter talk earlier on, and I think the way that he framed the prevailing expectations of corporations at COP26 was interesting. We were seeking to ignite ambition, and look, I don't think we should trample on ambition. Every 4 years, we ignite the ambition of millions of children to become Olympians. Ambition is not a bad thing, and some of those move beyond ambition to action and go and attend Olympics and win medals. And I think we are now at the point where we really need to move beyond ambition to action. And I think the transition planning work is how you actually do that, because it's the building blocks of getting to zero. But I think there has been a realization that ambition served its purpose. Ambition, once the dust settles and you actually consider the policy environment, the technology costs of abatement, the prevailing evolution of carbon prices, it is not at the moment creating an operating environment where every molecule is economic to abate. And I think companies are now rightly starting to work out what they can address through efficiency. I think it's harder than I might expect it to be to work out what companies will be able to free ride on in terms of just underlying greening of the grid. I'd love to see a central repository as what will be the carbon emissions of grids across the world going forward. And I know it's a moving target, but I think that would be a helpful input for people just understanding how they can effectively ride at least their electricity bill to zero. But then as they start to get into some of the harder to abate issues, I think it's becoming clear now that there are things you can control within the four walls of your business in your scope 1. There are things you can do to bend the curve in your scope 2 in terms of different procurement, with a challenge there that a lot of the world's green electrons are going into compute rather than necessarily into retiring conventional energy on the grid. And then as Peter and others have alluded to, the real challenge then is the value chain. And I think one interesting lens that is often really not well considered is, of the scope 3 emissions, what are scope 1 processes I will require abatement versus what are scope 2 issues that will effectively just require the deployment of renewables. And then how far are they removed? Tier 1 suppliers, Tier 1 customers, where you have a direct commercial and economic relationship, there is real capacity to influence. But if you start to go into Tier 3 and 4 and beyond, I think that is where it becomes much, much harder for companies to effectively influence outcomes over the medium term. But I think people are embracing that reality now. They're embracing the complexity and starting to do the work. But I think they're also, as your work alluding to, it's much harder to actively decarbonise a business than it is to articulate ambition. We have about 30 portfolio companies that cover about 4.5 megatons of emissions, where we've actively worked with them to conduct that abatement capacity exercise. We now understand what's proven, what's probable, and what's uneconomic for them to abate, and they're all moving forward in building transition plans. But I think the feedback loop of how do we make the probable proven, and how do we make the uneconomic over time probable and in turn proven, is where a lot of companies are naturally scratching their heads today.
So it wouldn't surprise you, presumably, that Simon's numbers are showing that we've got this kind of hump of companies that have got to the easy wins, and now they're kind of facing the wall almost in terms of the hard stuff. So is that something that resonates with you, presumably, in your dialogues?
Absolutely.
Okay. So Simon, let's come to you now. You've had a rest. Let's dig into some of the detail. Tell me about what's behind some of these numbers, and there's obviously the recurring question about kind of corporates stalling or pulling back or kind of not delivering on promises. Now, I know obviously the data takes a while to that comes through in terms of corporate disclosures, but do you see that in your research? Do you feel this sense of pullback? Are we going in reverse?
Well, I think the first thing to say is that it is too early to see the extent to which corporate rollback is affecting the data on the aggregate. That's something that we would expect to be, insofar as it's happening, it's something we would expect to see over the next 6 to 12 months in our analyses. I think, listening to a lot of conversations this morning, what's really resonated with me is that although there are places in the world and sectors of the economy where there are drivers to roll back, there are also places in the world and sectors of the economy where the direction of travel is still forward. So, anything I say about rollback at this stage is essentially speculation, but I think that yes, we may see some evidence of it in, for example, the banking sector, in some of the long-term targets set by fossil fuel companies being rolled back. But it's far from clear to me that we're going to see a large rollback on aggregate, because there are still some significant tailwinds in terms of Europe is still fairly strongly committed to decarbonisation. Certain key emerging markets are becoming more committed to decarbonisation, and then there is the impetus that transition planning standards and guidelines are going to provide. So there are headwinds, but there are also tailwinds.
So let's look at the glass half full side of the equation then, shall we? And of the 2,000 or so companies that you're regularly analysing, where are the bright spots? Where's the part of the puzzle that's kind of perhaps further ahead?
Well, you can cut the cake in different ways. You can look at it on a sectoral basis. And then the sectors that tend to be relatively further on are unsurprisingly the sectors where abatement is technologically possible and relatively economically feasible, like electricity, or sectors where that might not necessarily be the case, but there's always been a lot of stakeholder pressure around sustainability, which has led them to develop relatively sophisticated ways of managing that pressure and managing climate issues. And conversely, the sectors that are weaker are where either abatement is hard, or there has not been a long-standing culture of trying to or needing to manage sustainability issues. You can also cut it geographically. Right? So we tend to see that companies that are headquartered in Europe are quite well on with the transition for various reasons that I think that you all will be aware of. And companies in emerging markets are a little bit further back in the transition, but those are the ones that are moving fastest in the right direction quite often.
Mm-hmm. So Richard, when it comes to your day-to-day job, and I think it's quite interesting, you're representing a very, very large investment group, body, asset owner, and therefore you have a lot of influence and power over the companies you invest in. Tell us about that. What do your kind of conversations look and feel like, and how does that help your investment strategy?
So I look, maybe a few things here. I think we should be careful not to overstate the influence that investors have. I think in credit markets, we can seek to negotiate contractual provisions that bestow obligations on the borrower to conduct certain actions. In the equities markets, and about 85% of our balance sheet is invested in equity assets. The rights we have, look, where it's private markets, we have shareholder agreements, management agreements, there'll be more governance rights as we will have secured through negotiations. But in public markets, we have the right to appoint the board, to approve the report and accounts, approve dividend distributions, changes to bylaws. There are actually relatively limited levers we have to drive change. And I think one of the things that I've reflected on over the last few years is what I've called this dynamic of the single actor solution to a system problem. If only governments would regulate, if only the real economy would decarbonise, if only investors would divest. It's like, okay, we need to actually, I think now, come together and acknowledge that we need a system level solution to a system problem. and that we need to both raise and level the playing field across the economy globally. And what I'd say is that the end state we desire is probably one where policy is climate aware by design, corporate strategy is climate aware by design, and underwriting standards are climate aware by design. Because at that point, you probably have a system that is on a footing to be climate aware by design and systematically allocating capital and frankly, real assets in ways that will decarbonise the real economy. I'd say the biggest challenge that I've noted in the last few years was what I'd say that the mantra of reducing financed emissions and how it inspired this view that we just need to grow green. It's worth just a moment reflecting on the arithmetic of that. 5% of the economy is green. If we double it, and double it again, it's going to take quite a lot of time and capital. We still won't have addressed the original 95% of the economy that was grey. There will still be 70% of the economy. The problem, though, of investing in that 70% of the economy today is your financed emissions will go up. Okay? And that is something that I think the initial commitments of the financial sector were inconsistent with that reality. The mantra was definitely grow green rather than green grey. I think that debate has shifted. But I think building and learning to use the muscles to do transition finance is something that takes some time to do, because unless the asset owner today, unless the people that own the business today, and we see lots of underwriting today where there is a clear pathway to provide capital to comprehensively decarbonise businesses. And the energy sector is a good example, right? The technology is feasible transition, but regulators need to be supportive of the implications of deploying this. It's not just the generation, it's the grid and often elements of storage. But it is possible to underwrite, but the capital, when it is initially deployed, will bring with it potentially megatons of emissions. And I think a real opportunity at a system level is getting comfortable that we need to mobilise finance to pursue a transition finance agenda. And that will bring with it a reality that financed emissions are probably going up before they come down. But as they're going up, it will be in the expectation that they come down quicker. So we have very constructive dialogue with companies. I think, as Peter alluded to earlier on, they are starting to see strategic benefits of decarbonisation and resilience. I think we're also eyes open to the fact that while it may not be, I'd say, the prevailing heuristic today, is that investment that has not been made in mitigation or adaptation will likely be viewed by prospective buyers of these assets as a contingent liability, just like an unfunded pension. If the enterprise value is 10, the net debt is 2, but it emerges as a heuristic that mitigation is going to cost another 2 to green the business, adaptation will cost another 2 to build resilience to warming, that will ultimately be deducted from the fair equity value of these assets. We're definitely not there, but as that heuristic emerge and those rules of thumb come to be deployed in the markets, I think we're quite confident that in the next decade, companies that are not proactively moving to green themselves at least as fast as their industries and adapt themselves to be at least as resilient as their industries will see value impairment.
Interesting. So we've got to look out at those valuation models that Peter was also talking about. So coming back to you, Simon, you mentioned net zero standards in your talk. Tell me a bit more about that. What are you seeing with that? Why are they important?
Well, what we're really trying to do here is take a closer look at key high-emitting sectors and provide a more granular view of what companies are doing to transition to net zero. So as I mentioned, the management quality framework in particular is sector agnostic and asks a set of questions of companies that you can ask to any company in any sector, and so that you can make comparisons. Carbon performance is tailored to the sector, but it only looks at the emissions and the emissions targets, whereas the net zero standards work focuses on the steps that companies are actually taking or not taking to deliver on their targets. Right? So you can, among the words you can use to describe that that kind of work are credibility. This could be taken as a measure of how credible companies' targets are, and implementation. Right? So that's what the work is trying to do, and then naturally you end up focusing on things like are companies spelling out how the transition is going to look for them in particular, and is their capital expenditure consistent with the targets that they've set.
Yeah, and I think that kind of final point you make is kind of the critical part that's not really there commonly, is it, around the demonstration around how a climate transition plan ambition or indeed actions map to capital allocation and kind of expenditure plans of the company.
No, you're right, and I think one of the reasons for that is it's difficult to be very prescriptive about how a company should invest in order to make the transition without falling on the wrong side of what we might call technological determinism and telling all corporates that you need to transition in exactly this way. So I think over time, we at TPI, but also I think many other organisations in this space have been feeling our way towards a set of metrics which strike the right balance between holding companies to account on their capex on the one hand and giving them the flexibility on the other hand to invest in the ways that work for them. So it's not easy.
Well, it sure isn't, but this has been a delightful conversation and really illuminating. So thank you so much indeed. Thank you to the audience, and I hope that was interesting for you. Enjoy the break.